Market conditions have been pretty unstable over the recent weeks. On the one hand, the uncertainties surrounding Greece's status in the euro area had negative implications for European markets and global risk sentiment. On the other hand, China's equity market rout had implications for the entire EM and Asia region in particular. In this environment, hedge funds suffered a blow in June, with the Lyxor hedge fund index down 2%, but hedge funds still managed to outperform traditional asset classes in a context in which rising correlations between equities and bonds since May had negative implications for CTAs in particular. So digging into the different hedge fund strategies, CTAs underperformed the other hedge fund strategies in June, down almost 5% according to the Lyxor CTA Broad Index, but CTAs have started to outperform again in July, and as a result of this long position on equities and bonds, they had negative returns in June since both asset classes were down, but in July they benefited from the poor risk sentiment, in particular on the long fixed income side. They also benefited from their short positioning on the euro against the USD. On the other side of the spectrum, long-short equity managers outperformed, but were still negative in June, down 1%. Long-short equity managers have seen those market neutral and variable bias strategies outperforming as expected, according to our recommendations. Nonetheless, Asian long-short equity managers were severely impacted by the drawdown in China's equity market, and in particular long-biased Asian long-short equity managers had suffered a severe drawdown in June and early July. This is in line with our expectations. We have turned negative on Asian long-short equity managers by end May, and as a result, this is not a surprise to us. We believe nonetheless that it is still too early to come back to Asian long-short equity managers, in particular those with a higher market beta. Finally, event-driven strategies delivered negative returns in June as well, down 1.8%, and we have tactically downgraded the event-driven strategy to neutral after having been overweight over the course of the first half. We are taking some profits on event-driven after a strong first half. We are cautious as a result of the adverse market sentiment, which impacts negatively deal spreads. So we are now neutral on event-driven and look forward for attractive entry points at a later stage in the year. We maintain the stance that this is a tactical neutral, a tactical downgrade, but we believe the potential of the strategy over the long term is intact. This is a tactical reweighting. Overall, hedge funds helped protect portfolios in June in front of the Greek and Chinese storms. Institutional investors continue to need diversifiers, and as a result, hedge funds have experienced strong inflows during the second quarter of the year. According to Morningstar figures, alternative UCITS received more than 15 billion euros of inflows in the second quarter. This is the second quarter in a row with inflows above the 15 billion euros threshold, and this is a 30% increase compared to the inflows we had during the same period of last year. So inflows are strong. Investors need diversifiers in a context in which the market environment is uncertain, and they have helped protect portfolios during this shaky period.